All right, good morning, everybody, and thank you for being here. It is 10 a.m., so let's go ahead and get started. But welcome to your homebuyer education class. And we do like to run this a little more like an accountability session. We'll be doing the Fannie Mae's HomeView education course, which is 100% free. So I'm going to put that link in the chat right now. If everyone could please go ahead and register, and that's going to ensure that you receive your personal certificate at the end, which is valid for up to a year, accepted by most lenders as satisfying the home buyer education requirement. And that includes the North Carolina Housing Finance Agency programs, which we will dive into a little bit later in the session. But that link is coming through now, the chat. And then I'm going to share my screen so we can go ahead and get started. All right, and I think I just heard someone else came in. Are we all able to hear that and see my screen right now? All right, perfect. So this is the certificate course for first-time home buyers. We'll be jumping into the left side of the screen in English today, but next Saturday, May 9th, can't believe how far in the year we are already, May 9th, vamos a hacer lo mismo en español. Entonces, si prefiere hacerlo así, puede registrar al evento. Ya está en Eventbrite, Facebook, LinkedIn, y Nextdoor. All right, back to English. A brief overview of what we're going to do is knowing when you're ready. And that's really just looking at kind of the differences between renting and buying and what makes more sense for you and your family right now. Number 2 is going to be saving for home ownership, which talks about some of the costs affiliated with it beyond just the down payment and the mortgage that everybody thinks about, as well as some strategies to help get in line and be prepared when you are ready to make that move. And number 3, understanding the mortgage loan process. That's the fun part. That's where we get to start talking about some numbers, start to break it down a little bit, what lenders are looking for, how you can submit the best application and make sure that you're qualifying and getting a loan that's going to be comfortable for you and your family, not something that causes financial stress. Number 4, shopping for a home. And I do want to stress the importance of 3 coming before 4 here. We'll talk a lot about pre-qualify versus pre-approval and why that's needed before you really dive into the home search process. Now, if you're just going to open houses, by all means, get started right away. Start seeing the inventory that's out there. But when we get into serious shopper mode, we are going to want to have that pre-approval with us. Getting ready to close your loan, that's where your agent's going to take over a lot for you. And then welcome to home ownership, where it's not all fun and games, but a lot of advantages. And there is a course assessment at the end. I know that sounds scary. It is not. It's like 15 questions. It'll take you about 5 minutes after we finish the course. And then you'll get an email to the email address that you registered with a lovely little certificate that you can give to your lender and check that box. I've done my homeowners education class. So knowing when you're ready, like I said, it's really the rent versus buy. And so should I rent or should I buy? And the biggest consideration here is usually financial. However, a lot of misconceptions surrounding mortgages, like having to have a 20% down payment, make a lot of people feel they have to rent. Now, that's not saying that sometimes renting isn't the better decision. And that's what we're going to look at here. So 3 options or 3 advantages, benefits of renting is you don't want to commit to one location because it provides more flexibility if and when you decide to relocate. This is the only one in this program that I don't necessarily agree with 100%, is you do still have a lot of flexibility to move as a homeowner. You can be beginning to grow an investment portfolio. You could live in the home for a year and then move out and use it as a rental property. So there still is a lot of flexibility with moving. But number 2 and 3 are, I think, extremely valid points, is renting, maintenance and repair costs, things that are broken, that's all going to fall under, your landlord, your property management company. And in certain communities throughout the United States, even in North Carolina, even parts in Wilmington, Leland, renting is significantly cheaper than buying. And it may afford you more lifestyle at the price. For example, in Leland, you can get a 4-bedroom duplex for under $2,000 a month. And that's including all of your amenities, pool, things like that. You're probably not going to find a brand new build with a mortgage payment that low if you're making a minimum down payment with all of those amenities. But that doesn't mean that you can't find a mortgage payment in that range. And we'll definitely get into that when we get into understanding the lending process. And we'll even be looking at a fund calculator. A lot of good Fannie Mae resources. These are all completely free to you, and it just helps you realize a lot more about your buying power. And then the third one is a point I really like. It's related to number 1. It's kind of moving, but not location. It's just talking about seeing a lot of different places. It gives you a chance to try out different types of living spaces and explore different neighborhoods. So maybe I want to live in Sunset Park a year, then try more historic area, and then I decide, no, let's go to Leland. I want a little bit more space. So it does give you that flexibility. Also, if I want to try condo versus townhome versus duplex. So those are kind of the benefits of renting. Now let's look at the benefits of buying and owning. And the first one, and I think the most important, is that a lot of people feel a sense of identity tied to their home. You can be proud of owning your home. It allows you to build equity over the long term. This is, again, something we'll look at a little bit more in the financing chapter. I don't want to mislead you and think you're going to be building tons of equity the first few years. When we look at an amortization schedule, you're going to see that is not the case, but you are a part of every single mortgage payment you make truly is going towards equity in your home. It also has potential tax advantages. So all that interest that you are paying in the first part of the mortgage, which we'll see on the amortization schedule, it's not for nothing. It's not just, rent throwing into the wind. You're still going to be able to deduct that on taxes depending on where, the amount that it falls on. And the best part, maybe, you can customize your space. You don't need permission to paint a wall, knock down a wall, depending. But you have a lot more flexibility. It is truly your own, even in that part when the bank is really the one owning it. So let's look at the advantage summary. Renting can cost less, but doesn't always. Shorter term commitment. But if you're signing a 12-month lease, we already kind of talked about that. Maybe it's not the shorter, but it is more flexible if you need to relocate, and maintenance and repair costs are not your responsibility. However, you don't have tax incentives. You can't deduct your rent. Rent could increase and regularly does. It's not an investment, and you're not building equity. Now, owning, you can build equity, and you do. The value of the home may appreciate. You have the satisfaction of homeownership, possible tax incentives, and make your space your own. The disadvantages, long-term commitment. Again, not seeing that as a long-term commitment, seeing it as a long-term investment strategy. You're responsible for all maintenance and repairs. And that one is eye-opening if you've never done that before. Relocation involves more than just moving. And that, I think, is the wonderful phrasing for it. It requires more. You just have to do a little bit more, but you can still make that move at the year mark and probably be in good standing with your mortgage and maybe even have an investment piece at that time. And the upfront costs are higher. And that, I would say, also generally is the case. We're going to discuss some amazing grant programs, also the North Carolina Housing Finance Agency Down Payment Assistance Program, which can certainly help lower those costs. All right, now the first part, and this is not the fun part. Before we get to shop and do the fun real estate math and the mortgage math, we got to do the personal math. And so this is tracking your finances. When considering whether to rent or buy, it's important to see where your money is going. Keeping track of your expenses can give you a better idea of areas where you could cut back a little extra money away to save for a house. Keeping track of your finances is a great way to get a more accurate view of your financial situation. And this was certainly alarming for me. Didn't know I ate out as much as I did. And we actually have a great resource I'm going to put in the chat right now. So I apologize that the screen share is going to get a little wonky here. But this is the Fannie Mae Affordability Calculator. All right, that link is coming through now. I'm going to switch over to this screen for just a second. And this is really cool. It gives you a chance. We're going to share another resource, and I'm going to give you all a challenge to do this for the next 2 weeks of tracking all of your expenses. And once you have those numbers, we can really play around with this. So let's say we make $6,000 gross a month. Remember, gross is going to be your pre-taxes, a $500 car loan, low credit card debt. Say we got our student loan all paid off. As much as I'd love to see a 5, that is a little optimistic. Let's use the national average at 6.3 right now. Sorry, that was the down payment. We're actually going to lower that. We'll do the minimum for an FHA. And then a 6.3. And so these are numbers you probably already know. We do want to get the exact numbers, but I encourage you just to fill this out right now. And you can see this is your max home purchase price. It tells you what your down payment would be, and then what the mortgage loan amount would be as well. And so it's giving you a good idea of what you may need to be saving for. Remember, you are going to have closing costs on top of this, but we can mitigate that with things like seller incentives, builder incentives, down payment assistance programs. A lot of ways to bring that number down. But ultimately, you do have to. This is giving you a first picture kind of the debt to income ratio, and we're going to see a lot more of that. So now let's jump back into the slides. All right, and part 2 is the things to consider before buying, how the home purchase process works, how to estimate how much you can spend on a home, why location can be a determining factor in your home choice. We all have heard location, 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 and the different types of homes to consider. And this can be anything from manufactured to the massive homes on the beach and really everything in between, and they all have their own advantages. So here's the process. We're going to pre-plan. That is what you're doing right now. You're already steps ahead of everybody else. You're going to get pre-approved or pre-qualified. We'll talk about the options, the differences. Again, pre-approved. If you're getting close, that is definitely the route you want to go. If you still got maybe 6 months on the lease, a pre-qualified could be a great way to open up a conversation with a lender and start viewing some properties with a little more authority, if you will. Number 3 is to find a real estate agent. I don't think I've introduced myself to this point in our class, so I apologize, but I am Cameron with Real Broker and One Real Mortgage. So I'm happy to help with this, but definitely interview other agents as well. You want to see who is the best fit, who you get along with the best, and who is going to represent you, the absolute best for you and your family. Number 4 is the search for a home, which a lot of people think is the most fun. It usually is when you first kick it off. If it drags on, sometimes you get really ready to get to the phase to make an offer. And that's where I think it really, really gets fun, because that's when everything starts to seem real. Then you're going to secure the financing. All right, back into it. Appreciate y'all's patience. And I believe we were just talking about secure financing, complete the mortgage application, get a home inspection, and close on your home. So let's talk about estimating what you can afford. That was the affordability calculator. You should have this on your screen now as well, if you want to open that up and play around with it. Think about location, school district. Where do you want to be? Do you need to be walking distance? Anything like that. And then type of home. You've got what most people think of when they're buying a home is the single family detached home. If you're a first time home buyer, condos and townhomes are great affordable options, and so are manufactured homes. Despite the stigma, can be an incredible opportunity both to begin home ownership and to develop equity, to build equity. So really cool opportunity there. Now your down payment. This is what most people probably view as the biggest obstacle. And there's so many programs out there. It doesn't need to be. And I'm not saying that means home ownership is for everybody. But I don't think just the misconception that I need to have this massive down payment, that's why I can't buy. A lot of people are stopped at the gates right because of that. And it just truly is not true. And let's read the small print down here. Depending on the mortgage you get, if certain requirements are met, your down payment could be as low as 3% of the housing price plus closing costs. For example, if you decide you could save $6,000, you could potentially buy a $200,000 house. Another one is the credit score. Now, I know you've probably logged into Credit Karma. You've seen a score there. That's a great place to start. That is not the exact same number that's going to be used by your lender. But you have a lot of options to kind of start looking at that credit score. A lot of people view it as a report card. And it does weigh any history, both positive and negative, but it's really not a look at the past. It's a projection of the future and your likeliness to repay a debt. So the factors that go into it are your payment history, how much money you owe compared to available credit, or your utilization ratio, how long you've had the credit, the different types of credit accounts you have, and how many new credit and loan accounts you've opened. Of course, it's going to look better to have longer seasoned accounts, less things opened more recently, utilization ratios as low as possible. But we'll also get a little bit more into that. Also, things like charge-offs, bankruptcies, 30-day lates, those all stay there for a long time. And this is actually pretty cool. I left this slide in there just because I wanted to make sure we highlighted the change. Is that this says by federal law, you can obtain a free credit report once every 12 months. You can now do that every single week. Same website, annualcreditreport.com. And you can pull every single week from the 3 credit bureaus, Experian, Equifax, and TransUnion. I would highly recommend everyone do that right after this call. First thing you're going to look for is just accuracy. Does anything on there seem like maybe it was fraud at some point? Maybe it's been paid. A lot of places are very quick to report a debt and not as quick to report it being paid off. So you just want to make sure that's accurate. Now, that free report is probably not going to have a credit score on there. You do have to usually pay for that, and that's fine. You don't need that just yet. You're just checking for the accuracy. And that's what this is saying here. Did you know in most cases your credit report will not include your credit score? You can check credit or loan statements, talk to a credit or housing counselor. Amazing free resource. We'll put that link in the chat as well. Find a credit score service or buy your score from one of the major reporting credit agencies. All right, improving your score. So where to begin is just get that big report. Depending if you had a lot of credit or if you haven't, might be a couple pages. It might be really long. But either way, print the whole thing off. We want the in-hand tangible copy. And then you're just going to go through the whole thing and see if anything needs to be corrected. If you do need to dispute anything, there is a process for that for sure. Now, these are just kind of the suggestions by Fannie Mae of the ways to pay down debt. It says pay more than the minimum debt. That's something you obviously always want to do. Paying that full statement balance is going to prevent interest from accruing and help you pay it down faster as well. You do want to keep those utilization ratios as low as possible. Halt credit card spending. Create a budget. We're going to look at a really good budgeting resource. I think I actually might have it on this slide. Where's that? I'm going to put that in here now. We're going to do the spending tracker. We'll pull it up a little later on though. And so this is actually going to pull up as a fillable PDF. Okay, now let's pop over to this. Your spending tracker. And it is tedious, but we're at the very beginning of the month. So what a great time to start it. Spending for the month of May. And you're just going to put down every single one of these categories. And then you've got your total spending. And you get some definitions here to really help you: gas, car payment, insurance, repairs, transit, ride services, cabs. Just to help you make sure you are considering all expenses. I do apologize, we're a little slow. Okay, creating the budget. And this is going to be your most important. A budget only works, though, if you are committed to it. So here are those two trackers. You're going to want to do both, and then we're going to have all the information we need for the debt to income ratio when we're finding out our true buying power. When it comes to saving for a down payment, you may not need as much money as you think. Some mortgage products require down payments as low as 3% of the total home price when specific requirements are met. Certain state and local programs may offer down payment assistance to first-time homebuyers and other eligible borrowers, so it's important to talk to your lender or find a local housing counselor to learn what options may be available to you. And on your if you are actively in the class right now on Fannie Mae, both of these are hyperlinks. The down payment assistance will bring you right up to the North Carolina Housing Finance Agency. I believe that is the only one showing right now. There's also an employment eligibility grant, which we'll get into. And then a local housing counselor is a wonderful free resource. So definitely take a look at those. All right, here's where a lot of people, the kind of closing costs that we might be forgetting is, in addition to saving for a down payment and financial emergencies, you have to plan for costs associated with buying a home. These are your closing costs, your prepaids like home insurance and taxes, and your moving related expenses. All right, introduction to debt. So basically, the debt to income ratio is how much debt you have compared to your income. And without getting too much into it, we're going to look at two different ratios here, kind of your front end and your back end ratio, which one, just the front end is just your housing expense. So where does all of your housing expense in relation to your debt burden? And then the other one, and I'm sorry, I misspoke there. So the front end or your housing ratio is just your housing to your income. And then the total is going to be your housing plus all of your debt in relation to your income. And both those numbers are important with how much you can qualify for. So the lower your DTI, the better. The debt income ratio will be a strong factor when determining how much you'll be approved to borrow, your interest rate, and other loan terms. In general, you'll need 50% or less to qualify, and that is going to be the total, not just your housing. So all of your debt combined. All right, and this is a little small on my screen. Hopefully it looks a little bit bigger on yours, whether you have it on your actual device or if you're just following along here. But the DTI ratio is your monthly debt payments divided by your gross monthly income and then times 100 to make it a percentage. Ways to improve it: review your budget, review your current credit report, and avoid large purchases. And now let's look at some other home buying expenses. I know it seems like all we've been talking about is expenses, but this is the most important part. Is in order to have long-term success as a homeowner, it starts with getting in something that is comfortable, not something that's going to financially stress you. And this isn't trying to place you in, something smaller, less comfortable than you're looking for. It's the opposite. It's making sure that the payment is comfortable so that everything else just falls into place. Now let's look at some closing costs. So you have your prepaids, you have home insurance, homeowner's insurance, mortgage insurance, depending on your loan type and your down payment amount, initial escrow amount, and then property tax payments. So estimate is usually 2 to 5% of the home price. And just another thing to factor in addition to your down payment. Some other expenses: moving costs, utility hookups, furniture, and home improvements. Depending on, the year of the home, and new construction is obviously going to have a lot less in the home improvements category. You're still going to want to do that home inspection that we're going to get to a little bit later, though. All right, now my favorite part, the mortgage loan process. So steps in the mortgage loan process, we've broken that process down into easy to follow steps in order to help you understand what it takes to get a decision on your loan. Find a lender. Yoo-hoo. Identify the right mortgage product for you. Determine whether to get pre-qualified or pre-approved. Again, pre-approval is going to be the better route. It just kind of depends on timing. Complete the loan application for pre-approval, loan processing and documents ordered for the loan, underwriting, and closing. So a few tips to help you choose a lender.